Welcome to this new edition of ARGOPULSE March 2024.
The economy remained strong and resilient in March, leading investors to delay expectations of a rate cut. Companies continue to post good results for the earnings season, boosting momentum in risky assets, particularly those involving AI technologies. However, central bankers foresee rates to remain higher for a longer period than expected. They are waiting for more clues on receding inflation towards 2% before cutting rates. This approach has led to the yield curve correcting upwards, which has resulted in the poor performance of the bond market. They will keep an eye on macroeconomic figures for signs of a labor market slowdown and continued disinflation that could lead to rate cuts. We advise caution in the equity market, despite remaining optimistic, owing to potential sectorial rotations and a shift from big caps to mid caps. The bond market may take a hit due to the upward shift of the yield curve, and volatility, particularly on the short-end yield curve, remains high. Despite moving inversely with the yield curve evolution, the gold price is expected to remain high due to structural buying by leading central banks. Additionally, oil prices could experience significant instability due to the tensions between the US and OPEC+ members regarding supply. To deal with such scenarios, we recommend investing in directional structured products such as Shark Note or Twin Win. We have identified several risks from the current macroeconomic conditions. The market's rate cut expectations don't match the real economy, which could negatively impact risky assets. High inflation could keep rates elevated, which could result in a deterioration of company activities and the global economy. A sudden economic decline could lead to a repricing of all assets, as current valuations don't align with such a scenario. The AI momentum has caused a distortion in tech stocks' valuations, implying that we might see a correction in the tech sector in the coming weeks. Political decisions or speeches may affect market prices during presidential elections. Geopolitical tensions can impact global markets, leading to inflation. For example, the recent attacks in a key shipping region in the Middle East have caused an increase in transportation costs. This month's recommendations focus on two main themes. Cryptocurrencies are becoming a popular diversification asset for portfolio allocators due to macroeconomic uncertainties. Unlike previous bull markets, the current upleg is underpinned by fundamental shifts in the crypto markets, a more robust regulatory framework, the adoption of the assets by institutional investors, and the ongoing crackdown on bad actors help foster trust in these assets. Therefore, now is a good time to consider investment ideas backed by blockchain crypto. Certain stocks, such as financials, tend to perform well towards the end of an economic cycle due to high interest rates and slowing inflation. Consumer confidence and purchasing power are high, resulting in increased borrowing and investment. Insurance companies can also provide a defensive role in case of an economic downturn. However, these stocks may be among the most affected in the event of a major economic slowdown. These insights provide us with a compass for navigating the current complex financial waters. Thank you for joining us today. Until next time, stay informed and stay curious.
Contact your Lincius Partners representative to explore further how to take advantage of the current market conditions.